Welcome back to the Deep Dive. I'm your host, and today we are doing something a little different. Usually when people picture the market, they have this very specific, very Hollywood image in their heads. You know the one I mean?
Oh, absolutely. The guys in the blue jackets screaming at each other, the chaos on the trading floor.
Exactly. The screaming chaos, papers flying everywhere, people shouting, buy, sell, phones slamming, maybe a little bit of that Wolf of Wall Street energy. It's visceral. It's loud.
It's dramatic.
Very dramatic. But today, we are completely dismantling that image. We are stepping away from all that noise and walking into a very, very different room. This one is quiet, it's cold, the only lights are these little green blinking ones.
You're talking about the server room?
A server room. And then metaphorically, we're walking from there into the library because today is all about the evolution of wealth management. We are diving deep into a stack of materials from the Canadian Securities Institute, specifically their Wealth Management Essentials, Volume 2.
Which, I have to say, it sounds incredibly dry on the surface. Wealth Management Essentials, Volume 2. You hear that and you think, okay, time for a nap.
Right. Not exactly a page turner.
But when you actually crack this thing open,
Right.
it is a gold mine.
Yeah.
It's basically a roadmap of how the entire industry is shifted from, stock picking and gut feelings to what I would call wealth engineering.
That is the perfect way to put it. Engineering. It's not about betting anymore. It's about building. And we have these three distinct worlds that are all converging in this material.
Right.
We have technology, all the bleeding edge fintech and AI stuff. Then we have ethics, the massive, massive shift toward ESG. And then we have the bedrock, the foundation of it all, the math, modern portfolio theory.
And the hook here, and this is for anyone listening who might be thinking, oh, great, math, I'm tuning out, is this fascinating paradox. The more powerful the machines get, the smarter they become.
The more the human matters.
Exactly. The human element becomes more valuable, not less. The machine can do the calculations, but it can't understand the why.
Right. The machine can calculate the efficient frontier, and we'll get to what that is, I promise. But it can't tell you why you're investing in the first place, what your goals are, what keeps you up at night.
So that's the mission.
That is the mission today. We are going to deconstruct how your money is actually managed today. Not how it was managed in 1985, but how algorithms, ethical considerations, and cold, hard math come together to decide where your savings go.
It's a bit of a journey. We're going from the microchip to the conscience, and then all the way down to the calculator.
I love that. Let's start with the microchip. Segment 1, the rise of the machines. We hear this word fintech thrown around constantly. It's on every pitch deck in Silicon Valley. It feels like a buzzword.
It does.
Is it just marketing fluff? Or is there real substance there?
Oh, there's massive substance, but you're right, the term fintech is a bit of a catch-all. At its core, it's just the application of technology to improve efficiency in financial services. That could be anything from your banking app, letting you deposit a check by taking a photo,
Sure, simple stuff.
all the way to high-speed trading algorithms that operate in nanoseconds. But the real engine, the thing that is actually changing the game, is artificial intelligence.
AI, the topic of the decade. But the source material makes a really important distinction here that I think most people miss. We tend to conflate AI with, a magic computer from the movies.
Like Skynet or HAL 9000.
Exactly. But they break it down into these specific types of learning, which is so much more useful.
It is, and it's important to remember, AI as a concept has actually been around since the 1950s. It's the broad umbrella term for computer systems performing tasks that usually require human intelligence. But under that big umbrella, you have machine learning, and this is where the real shift happens.
Okay, so what's that shift?
Well, traditional programming is you, the human, telling the computer exactly what to do. If X happens, then you do Y.
It's a flowchart. It's totally rigid.
It's a flowchart, exactly. If a situation comes up that you haven't programmed a rule for, the computer just crashes or does nothing. It's stuck. Machine learning is different. You tell the computer, here is a mountain of data. You figure out the rules. You aren't programming the solution. You are programming the machine to find the solution on its own.
That's a huge difference. You're not giving it the answers. You're teaching it how to learn.
You're teaching it how to learn. And the text outlines 3 specific ways the machine does this. And I think it's worth walking through these because they really explain how modern trading algorithms actually think. The first one is called supervised learning.
Okay, supervised learning.
Think of supervised learning like using flashcards to study for a test. You have a data set that is labeled. Let's say you want to predict a market crash.
A worthy goal.
A very worthy goal. So you show the algorithm a chart of the 1987 crash, the 2000 dot-com bubble burst, and the 2008 financial crisis. And for each one, you label it CR-ash. Then you show it charts of normal boring years, and you label those normal.
So you're giving it the input and the answer key. You're showing it what a crash looks like.
Yes. It learns by example. It looks for the common features in all the crash charts. Maybe it's high volatility, spiking interest rates, certain kind of yield curve, and it learns to recognize those patterns. Then you show it today's chart, which has no label, and you ask it, what is this? And it makes a prediction.
So it's great for prediction based on things that have happened before.
Precisely. But it's limited by what we already know. It can only find what we tell it to look for, which is why the next one is so interesting.
That brings us to unsupervised learning. This one sounds, I don't know, riskier, or at least more chaotic.
It's more adventurous, I'd say.
Yeah.
This is like dumping a giant pile of Lego bricks on the floor in front of the computer and just saying, sort these. But you don't tell it how to sort them. You don't say sort by color or sort by shape. The data is unlabeled.
Okay, so what does it do?
The machine has to find hidden structures or patterns that we humans might miss. It has to create its own categories.
Give me a financial example of that, because if I don't tell it what a crash looks like, what is it doing? What could it possibly find?
Okay, so imagine you have all the stocks in the S&P 500. A human analyst categorizes them by sector: technology, energy, healthcare, and so on. That's how we organize the world. That's a labeled approach.
Right, that's what I see on my trading screen.
But an unsupervised learning algorithm might look at all the price movements over 10 years and realize something really weird. It might say, hey, this specific biotech stock and this specific software company and this luxury goods retailer, they all move in perfect sync every second Tuesday of the month.
That's bizarre. Why would that happen?
We don't know. A human would never even look for that connection. But the machine finds these strange clusters of correlation that don't fit our neat human categories. It might find that, say, luxury car stocks and high-end real estate stocks are actually more correlated to each other than car stocks are to truck stocks. It finds the invisible threads connecting the market.
So it's literally finding the unknown unknowns, the things we didn't even know we should be looking for.
That is the perfect way to describe it, exactly.
Mm-hmm.
And then there's the third one, the one that feels the most like science fiction: reinforcement learning.
This one, when I was reading about it, it just reminded me of training a dog with treats.
That is the best analogy for it.
Yeah.
In reinforcement learning, the algorithm is an agent acting inside an environment. It's not just passively looking at data, it's acting, it's making decisions.
Okay, so it's a player in the game.
It's a player. So it makes a decision, let's say, buy Apple stock. If the stock goes up in the next 5 minutes, it gets a reward, a mathematical treat, a little plus 1 point. If the stock goes down, it gets a penalty, a negative 1 point.
So it's literally playing a video game where the goal is to get the highest score.
It is. And it plays that game millions, maybe billions of times in simulations. It runs through market history, trying random strategies at first, getting punished, getting rewarded over and over, until it evolves an optimal strategy to maximize the treats. It learns to trade by trading.
Trial and error on an unimaginable scale.
On steroids, yeah.
Yeah.
And all of this leads us to the concept of deep learning, which uses something called artificial neural networks, ANNs, that are designed to mimic the nodes and layers of the human brain. But the application of this that really blew my mind in the reading wasn't about numbers at all. It was about words. Natural language processing, or NLP.
Yes. I loved this part because usually when I think of quant investing, quantitative investing, I think of spreadsheets, price, volume, PE ratios, cold, hard numbers. But NLP is about reading English.
It's reading the news, it's listening to earnings calls, it's analyzing the language. There's a specific study cited in the material that I just found fascinating.
The Ronner and Arul one?
That's the one from 2022. They basically asked a simple question: can a computer predict the market just by reading the news?
Okay, but how? I mean, a computer doesn't know what good news feels like. It doesn't have emotions.
It doesn't feel, but it can count. They analyzed news sentiment from 2003 all the way to 2017. They programmed the NLP algorithm to look for specific adjectives and phrases, words like optimistic, growth, exceeded expectations.
Versus words like uncertain, headwinds, disappointing.
Exactly. It then assigns a sentiment score to every single article it reads. It essentially quantifies the vibe of the financial media on any given day.
So it's reading the mood of the market.
Precisely. And they built a strategic asset allocation based purely on this sentiment score.
Mm-hmm.
If the news was overwhelmingly happy, the algorithm bought more risky assets like stocks. If the news was sad or scared, it moved into safer assets like bonds. They didn't look at a single balance sheet or earnings report.
Just the language.
Right.
And what was the result?
It worked. It beat the benchmark. The sentiment-based portfolio outperformed the standard portfolio by about 0.5% annually, which, might not sound like a lot.
But over time, that's huge.
It's huge. But more importantly, it had a higher Sharpe ratio, which means it had better risk-adjusted returns. It took on less risk to get that outperformance. It turns out the tone of the media coverage actually contains real investable data if you can process it fast enough.
Which a human just can't. I mean, I can't read 10,000 news articles and 36 research reports before the market opens at 9:30 a.m.
No one can, but the machine can read them all in a fraction of a second.
Yeah.
And that brings us to the fuel for all this, big data. The text has this great breakdown of the V characteristics of big data: volume, velocity, variety.
I think we can all get our heads around volume. We're talking exabytes and zettabytes, just unimaginable amounts of information. And the velocity is the speed it's created at. But the one that really stood out to me was veracity.
Ah, yes, veracity. That's the kicker.
What is that?
Veracity is truth, accuracy, the quality of the data. Because here is the incredible danger of all this technology. If you feed your super advanced reinforcement learning algorithm a diet of fake news or bad data points or just errors—
Garbage in, garbage out.
Worse. It's garbage in, catastrophe out. You just automate bad decisions at the speed of light. Imagine an algorithm that scrapes social media for news. If it sees a fake press release saying the CEO of Amazon has stepped down, it might dump billions of dollars of the stock in milliseconds before a single human can verify if it's true.
Wow.
So in modern wealth management, cleaning the data, ensuring its veracity, is almost more important than the algorithm itself. You have to have a clean fuel source.
Okay, so we have this incredible technology. We have machines that can read the news, learn from their mistakes, find hidden patterns. Naturally, the finance industry said, how can we package this and sell it to regular people? And that brings us to the robo-advisor.
The democratization of wealth. Or so the marketing says.
Right. Let's define it first, because I feel like robo-advisor is a term people hear all the time, but they don't quite know what happens under the hood. It's not a physical robot sitting at a desk, right?
Sadly, no. Although that would be cool. A robo-advisor is essentially an online platform where you don't talk to a human advisor. You go to a website, you fill out a questionnaire, your age, your income, your goals, how you feel about risk, and an algorithm assesses your answers.
And then it builds you a portfolio.
It builds you a portfolio. Usually that portfolio is made of cheap, diversified ETFs, exchange-traded funds. It's designed to be a set-it-and-forget-it solution.
It seems like they're everywhere now. Wealth Simple, Questrade, Betterment in the U.S. But 10, 15 years ago, this didn't exist. Why did it blow up so fast? What were the drivers?
The text points to a few key drivers coming together at the perfect time. First, and maybe most important, is demographics. We're talking about millennials and Gen Z.
Don't you dare say avocado toast.
Laughs. I will not mention avocado toast. But look, this is a generation that grew up with the internet. They trust technology. They live on their phones. The idea of driving downtown, paying for parking, and sitting in a stuffy mahogany boardroom with a guy in a suit who uses confusing jargon.
Is there not?
It's their absolute nightmare. They want the Uber experience for their money. Low friction, on-demand, transparent.
And low cost. That has to be a huge factor.
It's a massive factor. Because robo-advisors primarily use passive ETFs, the management fees are often a fraction of what a traditional mutual fund would charge. And the transparency is key. You log in and you see exactly what you're paying down to the basis point. For someone with a smaller account, that's incredibly attractive.
But, and here is where our deep dive gets critical. The source material is not just a cheerleading squad for robo-advisors. It brings up some really serious limitations. Specifically, it focuses on that input phase, that questionnaire you fill out at the beginning.
Yes, this is the weak link in the chain. You can have this brilliant algorithm managing the money on the back end, but if the instructions you gave it at the start were flawed, the whole thing is flawed.
So the diagnosis is the problem.
The diagnosis is the problem. There were a couple of studies mentioned, one by Falloon and Scherer and another by Turtelt and Schultz. They basically analyzed these risk profiling questionnaires and found that they're often, well, they're blunt instruments.
What do you mean by that? How so?
For one, they often ask too few questions to really understand a complex human being. But the biggest failure they identified is that these simple questionnaires struggle to distinguish between two very different concepts: risk tolerance and risk capacity.
Okay, this is a crucial distinction. We use the word risk so loosely in everyday life. But in wealth management, those are two very different sometimes opposing forces. Can you break them down for us?
Absolutely. Risk tolerance is purely psychological. It's the sleep test. It's about your emotions. If the market drops 20% tomorrow, what is your gut reaction? Do you panic? Do you sell everything at the bottom? Or do you see it as a buying opportunity and shrug it off? That's entirely in your head.
It's your stomach for the roller coaster ride.
Perfectly put. Now, risk capacity is the opposite. It's not emotional at all. It's pure financial mathematics. It's, can you afford to lose 20%? Regardless of how you feel about it. It's about your time horizon, your income stability, your other assets.
Give us an example of where these two things might clash, because I assume usually they go together. You know, a rich person has high tolerance and high capacity.
Not always, and that's where the algorithms get into trouble. Imagine a 25-year-old freelance graphic designer. They have, say, $20,000 to their name. They fill out a robo-advisor questionnaire.
Okay.
The algorithm sees age 25, and its programming says, long time horizon, high risk capacity, let's put this person in 100% stocks.
Yeah.
Makes sense on the surface.
Seems logical.
But they are a freelancer. Their income is unstable. What if they lose their biggest client and the market crashes at the exact same time? They might suddenly need that $20,000 to pay rent for the next 6 months. If the portfolio is down 40%, they're forced to sell and realize that loss. Their actual real-world capacity to take that risk was very low, even though they're young.
Right. And you could have the opposite case with a wealthy 80-year-old.
Exactly. An 80-year-old with $10 million in the bank, they have enormous capacity. They could lose $5 million, and their lifestyle wouldn't change one bit. But if they grew up during the Great Depression, or they just hate the feeling of losing money, their tolerance for risk might be zero. They might panic over a 5% drop.
So a simple algorithm often misses this nuance. It sees age 25 and thinks risk taker. It sees age 80 and thinks safe. It misses the biography.
It sees the math, but it misses the biography. That's the perfect summary. And that's where the hybrid model is starting to emerge, where you have the robo for the portfolio management, but a human you can call to talk about this stuff. The source suggests we need better simulations.
What does that mean?
It means don't just show the client a pie chart with 60% stocks, 40% bonds. Show them a simulation of the 2008 financial crisis. Say, look at this red line. This is your life savings disappearing over 6 months. How does that make you feel right now just looking at it?
You're trying to make them feel the pain before it's real.
It's the only way to test tolerance. You can't just ask someone, are you brave? You have to scare them a little and see if they flinch.
I like that. So we've talked about who or what is managing the money. Now let's talk about what they're buying. We mentioned ETFs, but there is a specific breed of ETF that the material spends a lot of time on. It sits right in this uncanny valley between active and passive management, smart beta.
Smart beta. It sounds like a marketing term invented by a consultant in an airport lounge, doesn't it?
It really, really does. It's not just beta, it's smart beta.
But it's actually based on some real academic rigor. It's often called factor investing, which is probably a better name for it. To understand it, we first have to look at traditional passive investing. If you buy an S&P 500 ETF, you are buying a market cap weighted index.
Meaning the biggest companies, Apple, Microsoft, NVIDIA, get the biggest slice of your dollar.
Right. If a company's stock price goes up and it gets bigger, you automatically buy more of it. Smart beta comes along and says, wait a minute. Why are we weighting by size? Does a company's size actually predict its future returns? Maybe we should be weighting the index by something else, something smarter.
So it's a different set of rules for building the index.
Exactly. It creates an index based on factors. These are specific, quantifiable characteristics that have historically been shown to drive higher returns over the long term.
And the tax lists, 5 big ones. Let's run through them quickly, because if you're listening to this, you probably own some of these in your portfolio without even knowing it.
Okay, for sure. The first is value. This is the classic Warren Buffett, Benjamin Graham style. You're buying stocks that are cheap relative to their earnings or their book value. You are fundamentally a bargain hunter.
Looking for stocks that are on sale.
Exactly. The second one is momentum. This is basically the physics of the market. Objects in motion tend to stay in motion. Stocks that have performed well recently, say over the last 12 months, have a statistical tendency to continue to perform well in the near future.
Which feels really counterintuitive. You'd think the rule is buy low, sell high. Momentum is basically buy high and sell even higher.
It is. It's a behavioral finance thing.
Yeah.
It relies on the idea that investors are slow to react to good news, so the price keeps drifting up as more and more people catch on.
Okay, what else?
Then you have the size factor. Historically, small-cap stocks, smaller companies, tend to outperform large-cap stocks over the very long run, mostly because they just have more room to grow.
And quality, that sounds pretty subjective.
It sounds it, but you can quantify it.
Yeah.
Quality companies are ones with high return on equity, stable earnings growth, and low levels of debt. Think of them as the boring, profitable, well-run businesses.
And the last one is low volatility.
Right. This is the big paradox. It turns out that stocks that don't jump around as much, the less volatile ones, often deliver better risk-adjusted returns over time than the high flyers, mostly because they lose a lot less in down markets.
So if I buy a smart beta ETF, I'm essentially making a bet. I'm saying I believe the value factor is going to outperform, so I'm going to tilt my entire portfolio that way.
Yes, that's it. Exactly. You're trying to beat the market, get some alpha by systematically exploiting one or more of these proven factors, but, and there's a very big but here that the text highlights.
There's always a catch, isn't there?
There's always a catch. The biggest one is cyclicality. Factors go in and out of style, sometimes for a very long time. If you were a dedicated value investor from, say, 2010 to 2020, you look like an idiot.
Because big tech growth stocks were just crushing everything.
They were crushing everything. So if you buy a smart beta fund, you have to be psychologically prepared to underperform the main index for years while you wait for your chosen factor to come back into fashion. Most people can't do that. They get impatient and they bail out right before it turns around.
And then there's the cost. This part of the notes I found genuinely surprising. We're all taught that ETFs are cheap, but there's this hidden layer of fees we never talk about, the index providers.
This is a great detail from that study they cited. We all think the fees we pay for an ETF go to the fund manager, the Vanguards or the BlackRocks of the world. But the study found that the licensing fees paid to the companies that actually create the indexes, like S&P or MSCI, account for about 1/3 of an ETF's total expense ratio.
Wait, 1/3? Just for providing the list of names?
Yes, it's their intellectual property.
Yeah.
And for smart beta ETFs, because the methodology for building the index is more complex, those licensing fees are even higher. A smart beta ETF can easily have an expense ratio that's 3 times higher than a vanilla S&P 500 fund.
So you really have to ask yourself, is the smart part actually delivering enough extra return to cover the smart price tag?
That's the hurdle rate. You start the race already behind. You have to be very confident that the factor you've chosen is robust enough to jump that hurdle year after year.
Okay, so we've covered the tech and the products. Now we need to pivot to the conscience. Segment 4, ESG, environmental, social, and governance. Now, I feel like ESG has become a bit of a political football lately. You hear terms like woke capitalism thrown around.
For sure.
But the source material takes a very pragmatic, almost cold-hearted look at this. It's not about politics.
It's not. And that's the most important takeaway for any investor listening. The evolution of ESG has moved from a discussion about values to a discussion about valuation. That's the key. Well, back in the 1970s, ethical investing was for church groups. They didn't want to own what they called sin stocks, tobacco, gambling, alcohol. It was about saving your soul. It was a moral stance, and you were willing to accept lower returns for it.
And today?
Today, it's about valuation. It's about saving your bottom line. It's the simple capitalist realization that environmental risks are financial risks. Social risks are financial risks. If you ignore them, you are going to lose money, period.
The text breaks this down into E, S, and G. But let's look at the risks specifically, because I found this framing really useful. The material categorizes climate risks into 3 buckets: physical, liability, and transition.
Right. Physical risk is the most obvious one. It's easy to understand. If your company owns a factory on the coast and sea levels rise, your factory floods. That's a direct financial hit. If you are an insurance company and the number of wildfires triples, your payouts triple.
Straightforward. What about liability risk?
Liability risk is the lawyers showing up. Mark Carney, the former governor of the Bank of Canada, talks about this a lot. If your company knowingly contributed to climate damage, you could be sued for that damage. That becomes a massive liability on your balance sheet, just like debt.
And the third one, transition risk.
That's the policy risk. This is maybe the biggest one. If the world governments agree to a high carbon tax, or they ban the sale of gasoline cars by 2035, and your entire business model is dependent on selling gas engines, you have a serious problem.
You could have stranded assets.
Exactly. You might own billions of dollars of oil reserves in the ground that you are now legally not allowed to burn. They become worthless overnight.
There was a really concrete case study in the notes that illustrates this perfectly. And it wasn't an oil company, which I found interesting. It was Starbucks.
The coffee rust incident. This is a perfect example because it shows how the E for environment directly hits the P&L, the profit and loss statement.
So what happened?
Around 2009 to 2012, The climate in Colombia, a major coffee-growing region, shifted. There was excessive rain, less sun, and this created the perfect breeding ground for a fungus called coffee rust. It was devastating to the crop.
And Starbucks obviously needs a steady supply of coffee beans.
Desperately. Their entire supply chain was at risk of collapsing. If they can't get high-quality beans, they can't sell lattes. So what do? They didn't just write a check to a charity and call it a day. They treated it as a core business crisis,
A supply chain problem.
a critical supply chain problem. They partnered with NGOs like Oxfam. They adapted their CAFE practices, their own ethical sourcing standards. They literally sent agronomists down there to teach the farmers new techniques like planting specific shade trees, changing their soil management to make the coffee plants more resilient to this fungus.
So by helping the farmers, which is the social part, and fixing the soil and ecosystem, the environmental part, they saved their own product and their profits, the governance and financial part.
Exactly. It wasn't philanthropy. It was business survival. That is what modern ESG is all about. It's managing the long-term risks that don't show up on a standard balance sheet until it's way too late.
But for the listener who's just holding stocks, I mean, you aren't the CEO of Starbucks. You can't fly to Colombia and plant shade trees. So what can you do? The text talks a lot about shareholder engagement.
This is the really important concept of voice versus exit. It's a choice you have as an investor.
Voice versus exit.
Exit is what we traditionally think of. It's divestment. You sell the stock because you disagree with the company's practices. You wash your hands of it. You say, I'm not going to own this oil company anymore.
Voice.
Voice is the opposite. It's staying invested and using your rights as a shareholder to fight for change from the inside. You can vote on executive pay. They say on pay rules are a big deal. You can file shareholder resolutions at the annual general meeting to force the company to do things like disclose their carbon footprint or improve diversity on their board.
So the argument is, if you sell the stock, you lose your seat at the table. You have no more influence. If you keep it, you can at least yell at the board.
Precisely. And increasingly, the large institutional investors, the giant pension funds, BlackRock, Vanguard, they're using that voice to force changes. For them, divestment is the last resort. Engagement is the primary tool.
Let's pivot again. We've covered all the new stuff, AI, smart beta, ESG. Now we need to go into the engine room, the actual portfolio management process. Segment 5. The text outlines a 7-step process, but I want to focus on the big decisions an advisor or an individual has to make. Specifically, do you pick your own stocks or do you buy a fund?
This is the eternal question, isn't it? And the source material puts a pretty hard line on this, and it's based almost entirely on portfolio size. It suggests that if you have a smaller account, say $40,000, you really need to be in managed products like mutual funds or ETFs.
Why can't I just go and buy 5 stocks with my $40,000? I see people doing it on Reddit all the time.
ETFs. You do. And the reason is diversification. With $40,000, if you buy 5 stocks, you are incredibly concentrated. If one of those companies goes bust, you lose 20% of your entire wealth instantly. To get proper diversification across different sectors and geographies, you really need to hold 30, 40, maybe 50 stocks. The transaction costs and the sheer difficulty of managing that many positions with only $40 make it completely inefficient.
But if you have, say, $500,000.
Now it's a different story. With a $500,000 account, individual stocks become a much more viable option. You have enough capital to build a properly diversified portfolio yourself.
And there's a tax reason for doing that too, right? Something about control.
Yes. This is a huge, often overlooked advantage of owning individual stocks. It's the control factor. When you own the stocks directly, you're the only one who can decide when to trigger a capital gain. You decide when to sell.
Okay. And with a mutual fund?
With a mutual fund, you're in a pool with thousands of other investors. If the fund manager has to sell a stock that has gone up a lot, maybe to pay out someone who is leaving the fund, they trigger a capital gain. And that gain gets distributed to all the unit holders in the fund.
So you could get a tax bill at the end of the year, even if you didn't sell a single unit yourself.
Exactly. It's called a phantom distribution, and it drives investors crazy. Owning the underlying stocks directly protects you from that completely.
Now, within this process, we have the other big eternal debate. Active versus passive. We touched on this with smart beta, but let's look at the broader picture. Active managers try to beat the benchmark. Passive managers just try to match it.
And the stats, year after year, generally show that most active managers fail to beat their benchmark after fees.
Right, but the source material references this fascinating theory by Pastor and Stambaugh about the size of the active industry. It's not just about active being good or bad.
Yeah, I love this theory. It's almost biological. It treats the market like an ecosystem with predators and prey.
Okay, I'm intrigued.
The theory asks, if passive funds usually perform better, why does active management still exist at all? And Pastor and Stambaugh argue that there is a finite amount of alpha. That's the term for the excess return, the opportunities to beat the market.
So there's a limited number of gazelles for the lions to hunt?
That is the perfect analogy. When the active industry gets too big, when there are too many lions on the savannah, there aren't enough gazelles to go around. They compete with each other, they drive down the opportunities, and after you account for their fees, their returns drop. They start to underperform.
So what happens then?
Investors get angry. They fire their expensive active managers and they switch to cheap, passive index funds. The lions starve and their population shrinks.
So the active industry gets smaller.
Right, the active industry shrinks. But here's the magic part of the cycle. When there are fewer active managers out there looking, opportunities, the gazelles start to reappear. Inefficiencies creep back into the market because nobody is watching as closely. The remaining lions are feasting.
And they start posting huge returns.
Exactly. The few active managers left start making huge returns. Investors see this, they get FOMO, and they rush back in, and the whole cycle restarts.
So it suggests there's an equilibrium, an optimal size for the active industry. It can never die completely, because if everyone went passive, prices would stop making sense because no one would be doing the research to set them.
That's the theory. It's not that active is bad. It's that crowded active is bad. It's cyclical.
Okay, brace yourselves, listeners. We are entering the deep water now. Segment 6, the math. Modern Portfolio Theory, or MPT. This is the physics of finance. And it all starts with one guy, a PhD student named Harry Markowitz, back in 1952.
The father of it all. It's hard to overstate his importance. Before Markowitz, investing was just pick good stocks. If you wanted a safe portfolio, you picked safe stocks like rail companies or utilities. If you wanted growth, you picked risky ones. It was very one-dimensional.
You just picked stocks you thought would go up?
Right. Markowitz completely changed the definition of risk. He said, risk isn't about the volatility of one individual stock. It's about how that stock interacts with all the other stocks in your basket.
And the magic word, the Rosetta Stone of MPT, is correlation.
Correlation. That is the entire game. It's a number that runs from +1 to -1.
Okay, break that down.
A correlation of +1 means two assets are married. They move in perfect lockstep. If asset A goes up 10%, asset B goes up 10%. There's no diversification benefit at all.
A correlation of 0.
Means they are complete strangers. The movement of one tells you nothing about the movement of the other.
Index 1.
That's the holy grail. Perfect negative correlation, they are perfect opposites. When one zigs, the other zags. When one goes up, the other goes down by the same amount.
And the whole goal of portfolio construction is finding things that don't move together.
Exactly. The text talks about the concept of the efficient frontier. If you imagine a graph with risk on the horizontal axis and return on the vertical axis, the efficient frontier is this curve that represents the highest possible expected return you can get for any given level of risk. You want your portfolio to be on that line.
But let's get to the most counterintuitive part of this, the concept of the minimum variance portfolio, or MVP. This is the part that breaks people's brains a little.
It does.
Imagine you have a portfolio that is 100% in a safe asset, like government bonds. Common sense would tell you, if I add any amount of a risky asset, like stocks, to my portfolio, my overall risk must go up.
That's what intuition says. And Markowitz proved mathematically that this intuition is completely false.
Wait, so adding risk can actually reduce my overall risk? How is that possible?
Yes, because of correlation. If the stocks you add tend to zig when your bonds zag, they smooth out the ride to the whole portfolio. The classic analogy is you own an umbrella company and a sunscreen company. Both are individually risky. Their sales are completely dependent on the weather. But if you own both of them together, your combined portfolio is incredibly stable. You make money whether it rains or shines. Markowitz showed that a portfolio of, say, 20% stocks and 80% bonds can actually have a lower standard deviation, lower volatility, lower risk than a portfolio that is 100% of bonds.
That is the one and only free lunch in finance.
The only free lunch. Diversification. It's the only way you can increase your expected returns without increasing your risk if you get the correlations right.
Then along came William Sharpe, who was essentially Markowitz's student, and he built on this with the CAPM, the capital asset pricing model.
Right.
This gives us a formula to actually price risk. But there is one specific crucial takeaway from CAPM that I think every single listener needs to hear, and it's the distinction between systematic and unsystematic risk.
This is the tough love part of the theory. It's a hard truth. Systematic risk is the risk of the entire market. It's the ocean. It's things like interest rates, recessions, wars, inflation. It's the tide that lifts or lowers all boats. You cannot avoid this risk if you want to invest in the market.
So, because you can't avoid it.
The market pays you for taking it on. That's the market risk premium or the equity risk premium. It's your reward for being in the market.
Okay, so that's systematic risk. What's unsystematic risk?
Unsystematic risk is the boat leaking. It's the risk that is specific to one single company. The CEO quits. The new product is a flop. The factory burns down. That risk is unique to that one stock.
And does the market pay you for taking on that risk?
No. The market pays you zero for taking on unsystematic risk.
Zero, not even a little.
Zero. Absolutely nothing. And the logic is ruthless. The market doesn't reward you for it because you could have easily gotten rid of it for free.
By diversifying.
By diversifying. You could have bought 20 stocks instead of one. So CAPM basically says, if you hold a single stock, you are taking on extra risk. The risk that the CEO might quit, that you will never be compensated for. You're being heroic for no reason.
That is a brutal truth for concentrated stock pickers. It basically says, don't be a hero, buy the index.
Or at the very least, don't expect a reward for your lack of diversification.
So we have the theory. Now, how do we actually split up the money? This brings us to segment 7. Asset allocation. We've established that picking individual stocks is a form of uncompensated risk. So the real game becomes about the mix. Stocks versus bonds versus cash. The text cites the famous 90% rule from a study by Brinson, Biebauer, and Hood.
A legendary study. It basically says that about 90% of the variability of your portfolio's return over time is determined by your asset allocation policy. Only about 10% comes from picking the specific stocks or trying to time the market.
So the decision of whether to be 60% in stocks and 40% in bonds is infinitely more important than the decision of whether to buy Apple or Microsoft.
For your long-term outcome? Yes, absolutely. Now, the text does add an important nuance from a later study by Ibbotson and Kaplan. They clarified that while allocation explains the ups and downs, the variability, it only explains about 40% of the difference in performance between two different funds. So things like security selection and especially fees still matter for the final number you end up with. But for the average person, getting the asset allocation right is the single most important decision you will make.
And within that big decision, we have strategic versus tactical allocation.
Right. Strategic asset allocation, SAA, is your long-term blueprint, your home base. For many people, it's a 60-40 split between stocks and bonds. It's based on your goals, your risk tolerance, your age. It's supposed to be boring. It stays the same for years.
And tactical asset allocation, TAA.
That's the short-term detour. It's consciously deviating from your long-term plan to try and catch a short-term market opportunity. It's saying, you know what, I think tech stocks are overvalued right now, so I'm going to move 5% of my portfolio from stocks to cash for the next 6 months.
It's market timing, basically.
It's a form of market timing, yes. And it's very hard to do successfully, which is why rebalancing is so important. That's the discipline of forcing yourself to go back to the plan.
Rebalancing is psychologically so hard to do. It forces you to sell what's working and buy what's not.
It feels completely wrong. If stocks have a great year, they might grow to be 70% of your portfolio. To get back to your strategic 60%, you have to sell the stocks that just did great and buy bonds which might be doing terribly.
It feels like you're punishing the winner and rewarding the loser.
It feels terrible. But it is the very definition of buy low, sell high. If you don't rebalance, your portfolio's risk level drifts up without you realizing it, and you end up taking the most risk right as the market is peaking.
There was a great little scenario in the text about a fictional couple, the Farleys, and they had multiple time horizons, a retirement goal, which was long-term, and a vacation home goal, which was short-term.
This is such a classic and important advisor problem. You can't just have one single portfolio for everything in your life. The solution they proposed was asset liability matching.
Okay, what's that?
For the vacation home, they knew they needed the money in exactly 2 years. So for that specific goal, they bought a strip bond that matured in exactly 2 years. They matched the asset to the liability. There was zero risk they wouldn't have the money when they needed it.
But for their retirement funds?
For the retirement funds, they stayed in a balanced portfolio because they had a 20-year time horizon. They could afford to take the risk.
It's a form of mental accounting, but it's a really effective one. You separate the money based on when you need it.
Exactly. You don't gamble with the down payment money.
Finally, let's go global. Segment 8. International investing. Why should we even bother leaving home? I mean, the Canadian market has done okay.
It's done okay, but it's tiny. Canada is something like 3% of the total world stock market. It's a rounding error. If you only invest in Canada, you have what's called home country bias. You're
Right.
missing out on all the growth in emerging markets. You're missing out on the giant tech companies in the U.S. since the Canadian market is so heavily weighted to banks and energy.
But going abroad brings new risks, new dragons to slay. The big one is currency risk.
It is the silent killer of returns. Let's say you buy a stock in Europe. The stock goes up 10% in euro terms.
Hmm.
You're thrilled? Great. But while you held that stock, the euro fell 10% against the Canadian dollar.
Oh, no.
When you sell that stock and convert the money back into Canadian dollars to buy groceries, you made zero. The currency move completely wiped out your profit.
So when you invest internationally, you're always making two bets, one on the company and one on the currency.
You are. And there's also sovereign risk, political instability, and liquidity risk in smaller markets.
Yeah.
And then there's the big warning from the source material. The world is shrinking.
What do they mean by that?
Correlations between international markets are increasing. In a true global crisis like 2008 or the pandemic, all markets tend to fall together. The diversification benefit of investing internationally isn't as powerful as it used to be. When the U.S. sneezes, the whole world catches a cold. But that being said, it is still absolutely necessary for growth and diversification.
Okay, let's try and land the plane here. Let's unpack this entire deep dive. We have covered an incredible amount of ground. We started with AI reading the news. We moved to buying factors instead of stocks. We checked our conscience with ESG, and we grounded it all in the cold, hard math of Markowitz and Sharpe. The source material introduces this client persona, Gordon Miller. He's inherited some money. He's standing at this crossroads we've been talking about. Based on everything we've learned today, what is the message for Gordon?
I think the message is humility. The message is that the market isn't a casino you can beat with a hot tip anymore. It's a highly efficient global information processing machine that's increasingly driven by AI. For Gordon, it means don't try to outsmart the AI with a gut
All right,
feeling.
use the tools.
Use the tools. Use the diversification. Use the one free lunch that Markowitz gave us all those years ago. Unless he has a massive multi-million-dollar account, he should probably be using funds or ETFs to avoid that uncompensated, unsystematic risk. He needs global exposure for growth, but he needs to be aware of the currency risk. And whether he uses a robo-advisor or a human expert, the underlying physics of finance don't change.
Here's where it gets really interesting for the listener, though. We've talked about beta, that measure of market risk. We've talked about smart beta. But the final thought I want to leave you with, and this is something you and I were chatting about before the show, is this. Do you know your beta?
That is the question. And I don't just mean the beta of your stock portfolio. I mean the beta of your entire life. Think about your human capital, your job, your ability to earn an income. Is your job highly correlated with your investments?
Give us an example of what that would look like.
Okay, say you work in the oil and gas industry in Alberta. Your salary, your bonus, maybe even your job security, they all depend on high oil prices. The value of your house probably relies on high oil prices too.
A lot of things depend on that one factor.
Right. If you then go and fill your RRSP in your investment portfolio with a bunch of Canadian energy stocks, you have tripled down on a single bet. You have a correlation of +1 across your whole life. If the price of oil crashes, you could lose your job, your house value could drop, and your savings could vanish, all at the same time.
That is modern portfolio theory applied to real life. It's terrifying.
It is. But the lesson is constructive. You need to hedge your life. If you work in tech, maybe you should own more value stocks. If you work in the oil patch, maybe you should own more technology and healthcare stocks. You need to actively diversify your human capital away from your financial capital.
A massive thank you to the Canadian Securities Institute material for providing the backbone of this discussion. It's incredibly dense stuff, but it really is the instruction manual for how the modern world of investing works.
Knowledge is the best hedge there is.
Couldn't have said it better myself. Thanks for listening to The Deep Dive. We'll catch you on the next one.